There's a rhythm to markets, a pulse that beats beneath earnings reports, central bank meetings, and economic data. Sometimes it pounds with confidence. Other times it retreats in quiet fear. Investment analysts have long observed these collective shifts and given them shorthand names: risk on when optimism reigns and risk off when caution dominates. What if we could see these moods visually at a glance? That's precisely what the index level sector stock heat maps inside the new interactive data hub hosted on the InsightOne app offer, a dynamic real-time window into how sentiment moves across the entire S&P 500 and its underlying sectors. In this video, we'll explore what risk-on and risk-off regimes are, why they matter, and how heat maps can help analysts spot the shift as it happens. Risk-on and risk-off describe how much risk investors are willing to take. In a risk-on mood, they crave returns and dive into equities, high-yield credit, emerging markets, and speculative plays. Assets that thrive on economic growth and confidence, like tech stocks or small caps, tend to outperform. Volatility falls, correlations rise, and markets are flush with liquidity. In contrast, risk-off environments are marked by fear. Investors seek safety. They rotate into US Treasuries, gold, the Japanese yen, or defensive sectors like healthcare and utilities. Risky assets sell off in tandem, volatility spikes, and capital flows reverse. These aren't just day-to-day blips, they are mood regimes that often persist for weeks or months, shaping strategy, performance, and valuation across the board. For investment analysts, sentiment regimes influence everything. Discount rates rise in risk-off phases, suppressing equity valuations, especially for long-duration growth assets. Sector rotation flips, beta exposure is punished. Defensive balance sheets become more valuable. Credit analysts reevaluate spreads and liquidity risks. Portfolio managers rebalance. Yet, sentiment itself is notoriously difficult to quantify unless you have the right tools. Let's bring in the visual shown here to my left, InsightOne's interactive index-level sector stock heat map. What you're seeing here is not just a colorful collage of stock tickers. It's an entire market's risk appetite made visible. Green dominance indicates broad-based buying, typically a risk-on signal. Red patches, especially in high beta names or cyclical sectors, suggest defensive rotation or risk-off sentiment. The size of the blocks represents market capitalization, helping analysts weigh impact. A red apple or Microsoft carries more market signal than a green mid-cap. Sector clustering adds another dimension. When tech, discretionary, and financials are all surging together as seen here, it's a textbook risk-on alignment. In the heat map above, nearly every sector is painted green, from technology to financials, healthcare, and consumer discretionary. Even cyclical industrials and producers are gaining. This is no isolated rally. This is a classic risk-on day. A notable exception is Apple, down 3.74%, suggesting potential stock-specific headwinds, but the overwhelming market color is bright green. Analysts would do well to factor this into both tactical calls and forward-looking risk assumptions. Models that ignore such sentiment breadth risk mispricing near-term earnings multiples or underestimating capital flows into higher beta names. Heat maps can help analysts identify a number of different insights, such as validating or challenging fundamental narratives. If a model suggests growth stocks are due for a pullback, but the heat map shows broad tech momentum, analysts should reassess timing or triggers. Thinking about time relative trades. Should you rotate from staples to discretionary? From bonds into equities? A green heat map across cyclical sectors says yes, sentiment supports the move, detecting false narratives. If headlines scream fear, but the map shows widespread buying, sentiment may be recovering faster than perception. And finally, gauging correlation convergence. Broad green or red days often signal a shift in cross-asset correlation critical for risk management. And in risk-off regimes, the heat map flips. Analysts see red bleeding across cyclicals and tech, green in healthcare and utilities. Suddenly, capital preservation dominates over growth. That's a cue to reweight portfolios, update assumptions in models, and even reprice sovereign risk or corporate default spreads. Risk-on and risk-off transitions rarely reveal themselves through macroeconomic data alone. They don't arrive with press releases or GDP prints. Instead, they emerge quietly, subtly through the price action. That's where heat maps become invaluable. They allow analysts to see in real time where the early sector leadership is forming as sentiment begins to shift. They highlight dislocations, those moments when one stock bleeds red in an otherwise green market, or when defensives rally against the tide, offering clues that something deeper may be unfolding. And they offer confirmation too. When a rally in prices aligns with falling volatility or tightening credit spreads, the heat map becomes a visual affirmation that sentiment is truly turning. Instead of waiting for lagging indicators or the next Fed speech, an analyst can simply open the InsightOne app, scan the heat map, and instantly grasp where capital is flowing and where it's pulling away. Markets, like people, are emotional. Valuation matters, but it is sentiment that often sets the short-term direction. Recognizing whether we are in a risk-on or risk-off world doesn't replace fundamental analysis, it enriches it. InsightOne's heat maps give analysts a powerful edge. They take the abstract and make it visible. They allow you to spot the emotional tides beneath market movements, whether it's a bullish wave lifting semiconductors or a defensive surge into pharmaceuticals. And perhaps most importantly, they remind us that in investing, seeing the mood matters as much as seeing the model.